Coming up today, stocks bounce back led by tech on the back of a better than expected inflation report. However, is all as it seems. I'll take a look at real inflation and the factors driving it, an update on the commodities in the Middle East, bank earnings kick off tomorrow, Apple bounces back, and the little stock that closed up by more than 100% today. And so we had a bit of a buy the dip today in the market after yesterday's sell-off, creating a bit of a mixed picture up the front here. Still got a bit of weakness in the main indices. Same with most stock sectors. However, we've got semis bouncing back today, led by NVDA, and a bit of a bounce back in growth and momentum stocks. And that was thanks to the Magnificent 7 as a group closing up over 2% today. Thanks to some good moves from NVIDIA, bouncing off its 50-day up 4%. Apple putting in a good day, bouncing off support. I'll come back to this one a bit later on. Amazon finding new all-time highs, along with another good day for Alphabet Google, up over 2% to new all-time highs as well. And so you might be a little bit confused. We had CPI inflation yesterday come in hotter than expected, causing a big move in the bond market, sending yields higher, stocks coming off a bit. And then today we just got the Producer Price Index, PPI, coming in a little better than expected, with a month-over-month increase, 0.2%, a little bit lower than 0.3% expected, and core PPI coming in as expected at 0.2%. Now the thing you got to keep in mind with PPI, that's the prices at which producers sell goods and services. It's not the price for which us consumers pay. You also got to keep in mind the gasoline component of PPI was seasonally adjusted, in which the government can play around with the figures depending on seasonal trends and other external factors. However, we all know gas has gone up of late, and so not seasonally adjusted, gas was up 6.3%. And we can see that in this chart here of the daily national average gasoline price for regular unleaded in the green, having a huge divergence with the reported Producer Price Index gasoline here in the yellow. And so even though the headline number that we all got fed today was just marginally better than expected, inflation's still by far and large heading the wrong way, especially when you look at year-over-year increases, not to mention the huge amount of embedded inflation we've had over the last couple of years. More accurate look is personal consumption expenditures, PCE, which we'll get towards the end of this month, and that'll give a more accurate reading in what us as consumers are actually paying for our goods and services. And just because the government reported headline numbers say one thing, that doesn't mean it's true when it comes to the reality of what we're all actually paying for our goods and services and the increases we've had over the last couple of years. I'm sure many of you would agree. Feels like our food and other things have gone up a lot more than 3% per year these last couple of years. In the Wall Street Journal, one of the most respected publications in the world, definitely in the world of finance, just recently did a study of how far $100 goes at the grocery store after 5 years of food inflation. And so in this study, they got a selection of commonly purchased items that were valued at a total of $100 in 2019. Today, that same grocery list costs 36.5% more, with some items such as eggs and sports drinks climbed more than 40%, meaning shoppers would have to remove almost $37 worth of items to spend that same amount as in 2019. And like respected financial research analyst Charlie Bellio says, that 36.5% increase over the past 4 years, which translates to 8.1% per year, is much higher than the US government CPI figures, which show food price inflation of 24.9% or only 5.7% a year. So it looks like the US government could be using the food and beverage prices we're seeing at the Augusta Golf Masters tournament this weekend, in which you can get a pimento cheese sandwich for just $1.50, because I think a lot of people would agree the prices we're actually paying seem to be a lot more higher than what's been reported, just like the Wall Street Journal proved to us as well. And it really shouldn't come as any surprise. Ever since COVID, which you could think of as kind of the biggest economic event of our lifetimes, which the government and Federal Reserve absolutely flooded the markets and economy with liquidity, it would be surprising if we didn't get structurally embedded inflation. And just to run you through a few charts, the first one being the annual expenditure of the United States government. Prior to COVID, it was $7.5 trillion. The latest stat, $9.68 trillion. That's a 29% increase in 4 years. And because of that huge spending increase, creating a record government budget deficit, spending a lot more than what they take in. That's also blown out the debt pre-COVID from $23.2 trillion to now over $34 trillion. Actually, the latest figures show it at $34.5 trillion, and that's a 48% increase since pre-COVID. Not only that, the Federal Reserve, which literally just creates new money electronically, then buy treasuries, mortgage-backed securities, and a way to pump liquidity into the system, blowing out their balance sheet from $4.1 trillion pre-COVID to where we currently stand at $7.4 trillion. That is a huge 80% increase in just 4 years. On top of the federal government stimulus, that's blown out M2 money supply. That's all the money sloshing around in the economy and checking, savings accounts, CDs, term deposits, money market funds. Pre-COVID, $15.4 trillion. Here we are now, 20.7. That's a 34% increase. Not only have we had a massive amount of inflation in government spending, debt, Federal Reserve balance sheet, that's also flowed into asset price inflation, with the first being the huge increase in house prices. Pre-COVID, the average house price in America, $329,000. Here we are today, $417,000. That's a 27% increase, which is also translated into asset price inflation in the stock market. Pre-COVID till now, we're up 61% on the S&P 500. So you could kind of think of it as the US government abusing their power as reserve currency status and just creating so much more US dollars. And we can see that over the last 30 years. The purchasing power of your dollar is decreased 53%, while the total price return in the S&P 500 is up 867% in that same time. And there's no better argument for why you have to invest than this chart right here. For you to increase your wealth and standard of living, just to keep up with inflation, you have to participate and asset price inflation. And that's why inflation is one of the Biden administration's biggest problems right now in their efforts to get re-elected this November. As it doesn't really matter what's been reported month to month by economists, all us financial market observers. What really matters is how people are feeling when they go to the grocery store, when they go fill up on gas, with how much savings they have left over at the end of the month. It's that embedded structural inflation over the last 4 years that really affects people rather than month-to-month changes. And so after yesterday's CPI, we got a massive repricing in the bond market, pushing out cuts from June now till September, and that's going to make it look really political if Jay Powell was to go ahead and cut rates in September, which is only a matter of weeks out from the presidential election in early November. And we still have Fed officials determined to cut rates under the guise of getting in front of a potential recession, which, just like I showed you after all those charts, is a bit crazy to be cutting rates and pouring more fuel on this fire. They should be hiking more to get the annual change of inflation underneath 2%, to get rid of all that embedded structural inflation of 30-40% over the last couple of years. Because like I said, COVID was probably the biggest economic event in our lifetimes, caused a huge rip in property and stocks, and it's almost like having a global pandemic was a good thing, especially when looking at the wealth of the top 1% and how it's exacerbated the wealth inequality gap. Seems to be in favor of the top 1% to have global pandemics, maybe some wars as well. And we've still got some bulls on the street, like Fundstrap's Tom Lee, say investors should immediately buy the stock market's post-CPI dip with a June rate cut, as he still thinks a June rate cut is still on the table. As he's suggesting that disinflation will continue, and he's ignoring the recent moves in the bond market, saying the Fed may still go ahead and just start cutting in June. However, ignoring that narrative and even the better than expected PPI print we got today is long-term Treasury yields, which closed up higher again today. You can see that in the chart of the US 10-year. Higher highs, higher lows, almost hitting 460 today, causing a further sell-off in the bond market and lower highs, lower lows for high-yield bonds as well, with the dollar also breaking out. And so in my opinion, there doesn't even really need to be a Federal Reserve. If you want true free market capitalism, you let the market determine what interest rates should be. There'd be no bailouts. There'd be no artificial liquidity. We'll just let the traders, investors, and institutions that actually underwrite loans, let them price risk. However, we don't have that. We have the artificial interference of the Federal Reserve, and even them, in logical normal times, should only be cutting rates in response to an emergency, like we saw in 2008 with the banking crisis, or in response to a struggling economy and spiking unemployment to help stimulate the economy. However, we don't have that. We actually have one of the strongest jobs market that we've ever had. Unemployment rates near record lows. A flood of immigrants into the States, helping to keep jobs and consumer spending near highs as well. We've also got prices of big key inputs into our economy, like oil, holding up there, not only on increased demand from the States and China, but also geopolitical tensions. We're still waiting to see Iran's response to Israel, with the US saying a big attack could be imminent. We may see a direct attack from Iran straight into Israel instead of them using their militant proxies in the region. In which case, the US is not ruling out a response to that. Israel is not backing down. Iran may see this as an opportunity to wipe out the only Jewish state from the Middle East, and Israel may see it as an opportunity to finally cut down Iran after they've been poking at them for years and years and years. So this situation could still blow up. We've already got big airlines halting flights into the Iranian capital, Tehran, as they most likely have been given intelligence that something big may be about to happen over there. And there's a look at the price of light crude oil, just holding above $85 a barrel. Also saw a new high again today in gold, almost touching $2,400 an ounce. Silver as well, still holding up there. And it's actually silver has outpaced gold so far this year. And whenever there's a bull market in precious metals, you could think of silver as the much more volatile younger brother of gold. And some people might not realize the last big bull market in silver from October 2008 up till May 2011, price actually rose 500% just a couple of years, in which it almost hit $50 an ounce, and here we are at $28.50, still well off those all-time highs from more than a decade ago, especially if you would adjust that for an inflation. And agricultural commodities, still holding up there really strong, along with gas futures. Price of your coffee is about to go up, and the price of our chocolate still set to remain elevated for quite some time here. However, now on the street, the focus shifts from inflation into Q1 earnings season, with the big banks kicking things off tomorrow. We'll get to hear from JP Morgan, Wells Fargo, and Citigroup. And this is on the back of record profits last year. However, they're facing growing pressures this year, with losses from commercial real estate and bond portfolios. However, that hasn't really materialized into fear in the market. Bank stocks have actually been performing well lately, and that's because they're well backstopped by the Fed and Jay Powell, who is already dealing directly with the vulnerable banks, regionals on their commercial real estate issues, and the market is leaning hard against that Fed put, knowing that if anything were to hit the fan, the Fed would be there the next minute and pull out any stops they need to cool things down, just like we saw last March with the collapse of Signature and Silicon Valley Bank. And just a bit of a preview for what we're expected to see tomorrow. The financial sector as a whole is predicted to report the 6th highest year-over-year earnings growth rate of all 11 sectors for Q1 at 0.7%, with the insurance industry set to come out at front with 37%. Shouldn't be surprised as the biggest inflation is coming out of insurance. And if you actually took out insurance, the financial sector would be expected to report a decline in earnings of 6%. And overall, banks expected to come in minus 18%. There's a look at the financial sector ETF, trading below its 50-day again today, going into earnings tomorrow. A little bit of a pullback in JP Morgan. Let's not forget a few weeks ago, CEO Jamie Dimon sold $150 million worth of stock, first time ever. So it'll be interesting to see the move we get out of JP Morgan tomorrow and what he has to say about everything. But the real move today was in tech, helped by the second largest stock, Apple, having its best day in a long time. Got some analyst upgrades, but they've also come out, like a bunch of other big tech companies, and talking about their latest chips they're making on their own, planning to overhaul all their Mac products with next generation M4 chips with a focus on AI. It's music to the market's ears, as Apple's kind of been lagging on this subject of late, and it really wasn't that significant of news, so may just be a case of some big short covering here, maybe some new buyers stepping into the market, and just going out to a weekly chart. Seemed to bounce off that level where we bounced in October last year. However, the price still been going sideways about 2.5 years now, and I'd say we're likely to get much more of that as well. Also had a huge move down in a mid-cap insurance company today after short seller Fuzzy Panda Research published a report saying Globe Life, under ticker GL, are engaging in insurance fraud, writing policies for dead people, forging customer signatures, withdrawing funds from consumers' bank accounts, pretty wild accusations, to help back up their short position. And it appears to have worked pretty good. Stock down 53% today on huge volume. This is a $10 billion market cap company that's been around for over 40 years. So I'd say the insiders have got some answering to do. May get a knock on their door from the regulators as well after this. The craziest move today was in Rent the Runway, which is a business that rents clothes online just after they released their fourth quarter and full year results, along with guidance. So they expect their revenue to grow between 1 and 6%, and they're reducing their fixed costs. And again, I think this might be a case of some huge amount of short covering as well. As of last count, there was over 7 million shares short, given a pretty high 14.8 days to cover. And you can see why short sellers were short. The common tactic is to jump on board these kind of stocks, meme stocks, small stocks in trouble, short the heck out of them. And then when you get half decent news, it just causes a massive uncoiling. We actually finished up 161% today, but this is a really tiny stock, 26 million market cap, and so I just thought that was an interesting look at some of the things that go on down the bottom of the stock market. Moving on, those Fed fund futures pretty much still the same as yesterday, just pricing in Fed's going to cut just once more this year in September in their last meeting before the presidential election, which is on the 5th of November, and the Fed meets again 2 days later. Greed index feeling greedy again at 59, and still no love here from corporate insiders. Not doing much buying at all. Bit of a sharp fall in short-term breadth. Even today, on the bounce we got, still got less than a third of stocks above their 20-day average. And actually again today, we saw new lows outpace new highs in the Nasdaq, 66 to 35. Had a big spike early on in the VIX. However, it reversed, finished a little bit lower, finishing under 15. I'd say we're still elevated a bit here. Market could be still a little bit on edge with what's going to happen in the Middle East with Iran set to attack Israel. And we all don't know how big they're really going to go and then what sort of response we'll see from Israel, and potentially in tandem with the Western Alliance, could turn into an all-out war between Iran and Israel. As we look at Bitcoin just holding ground above $70,000 a coin, it looks like China large cap ETF FXI may have just taken out this big long-term downward trend line today, making it look more and more likely that this was the low back in January. And there's a look at the semi sector defending its 50-day pretty well here, along with the bounce in growth stocks today. Still a bit of weakness in Trump media pulling back, although these other new stocks, Astera Labs having a good day, Reddit trying to hold ground, along with Super Microcomputer just underneath its 50-day, and MicroStrategy just above it. Well, the big energy, oil and gas stocks still look to be holding their parabolic uptrend. Sharp pullback today in Root Insurance being the hottest stock lately. No surprising to see a bit of a pullback then after we've just been more than 140% above the 50-day. And other hot stocks, GE, Aerospace, Vertiv and Wingstop still holding on to their uptrends. And there's a look at Wells and Citigroup going into earnings tomorrow. Okay, so it's a little challenging what to make of this market here. We're having a pullback in the S&P, kind of just held ground here today after that PPI. Maybe we get a move after bank earnings tomorrow. I mean, Jamie Dimon did just sell a lot of stock. Be surprising if we did see a big gap up, although it's still definitely possible. And we're kind of a little mixed here, looking at the overall market picture. So I'd say the market's kind of struggling for direction. And given that move lower in bonds, on the back of yields increasing again, not to mention crude holding up there, stock market is doing remarkably well to hold up, still on the face of all of that, even though we've got option dealers and pricing in more volatility ahead, and a strong dollar as well, which is normally negative for stocks. And overall in the big picture, bonds are looking more attractive relative to stocks, first time in a long time, with my optimal stock bond allocation, which updates at the start of every month, currently about 40-60 stocks to bonds, and that gap will increase even further next month if we stay where we are, because we've had an increase in yields while stocks are still holding up. So it looks at the relative valuation. And the last time we saw a recommended allocation to bonds over stocks like that was in 2007. It did last a couple of years, and that was going into the great financial crisis. So it could be a case of stocks still just hanging on to the hopes that we are going to get a Fed rate cut, or possibly the economy is so strong it doesn't even mind if we get cuts or not. Either way, we should get a little bit more of a tell tomorrow with the market's reaction to bank earnings. So thanks very much for tuning in to the Daily Market Review, and I hope to see you again here tomorrow night. Cheers.